This video is on basic accounting procedures. This part of the video will deal with journal entries. We begin with double entry system. The double entry system of bookkeeping has emerged in the process of evolution of various accounting techniques. It is the only scientific system of accounting. According to it, every transaction has twofold aspects, debit and credit, and both the aspects are to be recorded in the books of accounts. Therefore, in every transactions, at least two accounts are affected. For example, on purchase of furniture, either the cash balance will be reduced or a liability to the supplier will arise and a new asset, furniture, is acquired. This has been made clear already. The double entry system records both the aspects. It may be defined as the system which recognizes and records both the aspects of a transaction. Now, let's have a look at the advantages of double entry system. The system affords the undermentioned advantages. By the use of this system, the accuracy of accounting work can be established through the device of the trial balance. The profit earned or loss suffered during a period can be ascertained together with details. The financial position of the institution or municipal corporation concerned can be ascertained at the end of each period through the preparation of balance sheet. The system permits accounts to be kept in as much details as necessary and therefore affords significant information for the purposes of control, etc. Results of one year may be compared with those of previous years and reasons for change may be ascertained. It is because of these advantages that the system has been used extensively in all countries. Now, let's talk about debit and credit. Debits and credits can be considered as pluses and minuses. Hence, debiting an account means increasing the pluses, while crediting an account means increasing the minuses. Every financial transaction will affect at least two accounts. They will be debited and credited such that the debits will be equal to the credits. In other words, the sum of pluses and minuses will be zero. Some accounts are plus or debit nature accounts. In order to increase them, they must be debited. Examples include cash, bank, payments, and assets account. For example, if Rs 100 is received in cash, the cash account is debited to increase the cash balance. Other accounts are minus or credit nature accounts. Hence, in order to increase them, the accounts must be credited. Examples include various income and liability accounts. Hence, if the Rs 100 received above is on account of house tax, the house tax account is to be credited to record the increase in income. As a result of this, debit is equal to credit, that is, the entry is complete. Plus nature accounts can be credited to reduce their balances, and similarly, minus nature accounts can be debited to reduce their balance. For example, if Rs 30 is paid as wages out of the Rs 100 received above, the accounts affected are wages account, which is a payment type, which is a plus account, and cash account, which is an asset type, which is also a plus account. However, since cash is going out, the account needs to be reduced by credit and wage account needs to be increased by a debit of Rs 30, thus completing the entry. Formally, accountants use the term debit (DR) to denote an entry on the left side of any account and credit (CR) to denote an entry on the right side of any account. We know that by deducting the total of liabilities from the total of assets, the amount of own fund is ascertained, as is indicated by the accounting equation. The equation being assets is equal to liabilities plus own fund, or assets minus liabilities is equal to own fund. To understand the equation better, let us expand it. Assets is equal to liabilities plus own fund, or assets is equal to liabilities plus contributed capital plus beginning retained earnings plus revenue minus expense minus dividends. Here, contributed capital is the original capital introduced by the owner. Beginning retained earnings is the previous earnings not distributed to the shareholders. Revenue is generated from the ongoing activities of the business, and expenses are the cost incurred for the operations of the entity. and dividends are the earnings distributed to the shareholders of the entity. We have also seen that if there is a change on one side of the equation, there is bound to be a similar change on the other side of the equation, or amongst items covered by it, or an opposite change on the same side of the equation. It is a tradition that increase in assets are recorded on the left-hand side and decrease in them are recorded on the right-hand side. And in case of liabilities, increases are recorded on the right-hand side and decreases on the left-hand side. When the two sides are put together in T form, the left-hand side is called the debit side and the right-hand side is called the credit side. When in an account, a record is made on the debit or left-hand side, one says that one has debited that account. Similarly, to record an amount on the right-hand side is to credit it. From the above, the following rules can be obtained. When there is an increase in the amount of an asset, its account is debited. The account will be credited if there is a reduction in the amount of the asset concerned. Suppose a municipal corporation purchases furniture for Rs 8 lakh. The furniture account will be debited by Rs 8 lakhs since the asset has increased by this amount. Suppose later, the municipal corporation sells furniture to the extent of Rs 3 lakhs, the reduction will be recorded by crediting the furniture account by Rs 3 lakh. If the amount of liability increases, the increase will be entered on the credit side of the liability account, that is, the account will be credited. Similarly, a liability account will be debited if there is a reduction in the amount of liability. Suppose a municipal corporation borrows Rs 5 lakh from the state government's account will be credited since Rs 5 lakh is now owing to the state government. If later the loan is repaid, state government's account will be debited since the liability no longer exists. An increase in the own funds is recorded by crediting the municipal fund account. Suppose the municipal corporation introduces additional fund, then the fund account will be credited. If the amount is deducted from the fund account, the municipal fund account will be debited. Profit leads to an increase in the municipal fund account and loss leads to a reduction. According to the rule mentioned in point 3 above, profit and incomes may be directly credited to the municipal fund account and losses and expenses may similarly be debited. Expenses are debited and incomes are credited. Since incomes and gains increase the municipal fund, the rule is to credit all the gains and incomes in the accounts concerned, and since expenses and losses decrease the municipal fund, the rule is to debit all expenses and losses. Of course, if there is a reduction in any income or gain, the account concerned will be debited. Similarly, for any reduction in an expense or loss, the concerned account will be credited. The rules given above are summarized below. 1. Increases in assets are debits, decreases are credits. 2. Increases in liabilities are credits, decreases are debits. 3. Increases in municipal fund account are credits, decreases are debits. 4. Increases in expenses are debits, decreases are credits. 5. Increase in revenue or incomes are credits, decreases are debits. The term debit and credit should not be taken to mean respectively favorable and unfavorable things. They merely describe the two sides of accounts. Now, let's talk about transactions. A transaction is a type of event which is generally external in nature and can be determined in terms of money. In an accounting period, every business has a huge number of transactions which are analyzed in financial terms and then recorded individually, followed by classification and summarization process to know their impact on the financial statements. A transaction is a two-way process in which value is transferred from one party to another. In it, either a party receives a value in terms of goods, etc., and passes the value in terms of money or vice versa. Therefore, one can easily make out that in a transaction, a party receives as well as passes the value to other party. For recording transaction, it is very important that they are supported by a substantial document like purchase invoices, bills, payslips, cash memos, passbooks, etc. Transactions analyzed in terms of money and supported by proper documents are recorded in the books of accounts under the double entry system. To analyze the dual aspect of each transaction, two approaches can be followed. 1. Accounting equation approach, and 2. Traditional approach. Let's start by learning the accounting equation approach. The relationship of assets with that of liabilities and own fund in the equation form is known as accounting equation. Basic accounting equation comes into picture when sum total of own fund and liabilities equalizes assets, where assets are what the municipal owns and own fund and liabilities are what the municipal owes. Under double entry system, every transaction has a twofold effect on the entity, where each transaction affects changes in assets, liabilities, or own fund in such a way that an accounting equation is completed and equated. This accounting equation holds good at all points of time and for any number of transactions and events except when there are errors in the accounting process. Now we have an equation which is own funds plus liabilities is equal to assets, or own funds plus long-term liabilities is equal to fixed assets plus current assets minus current liabilities. Now let's learn about the traditional approach. Under the traditional approach of recording transactions, one should first understand the term debit and credit and their rules. Transactions in the journal are recorded on the basis of the rules of debit and credit only. For the purpose of recording, these transactions are classified into three groups. 1. Personal transactions. 2. Transactions related to assets and properties. And 3. Transactions related to expenses, losses, incomes, and gains. Now let's look at the classification of accounts. Personal account. Personal accounts relate to persons, trade receivables or trade payables. An example would be the account of Ram and Company, a credit customer, or the account of Jhaveri and Company, a supplier of goods. The municipal fund account is the account of the municipal corporation, and therefore it is also personal, but adjustment on account of profits and losses are made in it. This account is further classified into the following categories. Natural personal accounts. It relates to transactions of human beings like Ram, Rita, etc. Artificial or legal personal account. Entities are treated to have a separate entity. They are recognized as persons in the eyes of law for dealing with other persons. For example, government, companies, private or limited, clubs, corporate societies, etc. Representative personal accounts. These are not in the name of any person or organization, but are represented as personal accounts. For example, outstanding liability account or prepaid account. Next, we have impersonal accounts. Accounts which are not personal, such as machinery account, cash account, bank account, rent account, etc. These can be further subdivided as follows. A. Real accounts. Accounts which relate to assets of the municipal corporation but not debt. For example, accounts regarding land, building, investment in fixed deposits, etc. are real accounts. Cash in hand and cash at bank accounts are also real. B. Nominal accounts. Accounts which relate to expenses, losses, gains, revenue like salary account, interest paid account, commission received account. The net result of all the nominal accounts is reflected as profit or loss which is transferred to the municipal fund account. Nominal accounts are therefore temporary. Now, let's begin with the golden rules of accounting. All the above classified accounts have two rules each, one related to debit and one related to credit for recording the transactions, which are termed as golden rules of accounting, as transactions are recorded on the basis of double entry system. The following table shows the golden rules of accounting. When the account is a personal account, the account to be debited is a receiver, an account to be credited is a giver. When the account is a real account, we need to debit what comes in and credit what goes out. And when the account is a nominal account, then all the expenses and losses are to be debited and incomes and gains are to be credited. Let's understand this with some examples. From the following information, state the nature of account and state which account will be debited and which account will be credited. Wages and salary paid Rs 50,000. Rent received Rs 2 lakh. Purchased goods on credit Rs 9 lakh. And sold goods for Rs 8,16,000 and received payment in check. The solutions to all the above would be as follows. If the transaction is of wages and salaries paid, the accounts involved are wages or salaries and bank account. The nature of wages or salaries is nominal, whereas bank account is personal. And as per the golden rules of accounting, the expenses will be debited and giver will be credited. Therefore, the journal entry would be wages or salaries account debit to bank account. Similarly, if the transaction is of rent received, then there are two accounts involved, which are bank and rent. Bank is a personal account, whereas rent is a nominal account. As per the golden rules of accounting, we will debit the receiver and credit the income. Therefore, the journal entry would be bank account debit to rent account. In case of transaction of purchases made on credit, the accounts involved are purchases and creditor. Purchases is a nominal account, whereas creditor is a personal account. As per the golden rules of accounting, we will debit the expense and credit the giver. Therefore, the journal entry would be purchases account debit to creditor account. With regards to the last transaction of goods sold and payment received in check, the accounts involved are bank account and sales account. Bank account is a personal account, whereas sales account is a nominal account. As per the golden rules of accounting, we will debit the receiver and credit the giver. Therefore, the journal entry would be bank account debit to sales account. Now, let's study the modern classification of accounts. The traditional classification of accounts is real, nominal, and personal. Now, let us see the modern and more acceptable classification of accounts. The modern classification of accounts can be seen from the following table. If the account is an asset account, the normal balance of the account will be debit, and therefore the account will have to be debited in case of increase in assets and credited in case of decrease in assets. For liabilities account, the normal balance of the account will be credit, and therefore the account will be debited in case of decrease in liabilities and credited in case of an increase in liabilities. For municipal fund or capital account, the normal balance of account is credit, and the account will be debited when there is a decrease in the capital and credited when there is an increase in the capital. For revenue account, the normal balance of account is also credit, and the account will also be debited in case of a decrease in revenue and credited in case of increase in revenue. For expenses or expenditure account, the normal balance of the account is debit, and the expenditure account will be debited in case of an increase in expenditure and credited in case of a decrease in the expenditure. And in case of a withdraw account, the normal balance of the account would be debit, and the account will be debited when there is an increase and credited when there is a decrease. Let us solve the same example with the modern approach now. If the account involved is cash, then it is in the nature of an asset and it shall be debited to show any increase. If the account involved is capital, it is in the nature of liability and therefore it shall be credited to show any increase. If the account is wages or salary, then it is in the nature of expense and shall be debited to show an increase. If the account is cash, which is in the nature of asset, it shall be credited to show any decrease. If the account involved is rent, which is a revenue nature account, it shall be credited to show an increase. If the account involved is purchase, which is an expense account, it shall be debited to show an increase. If the account involved is a creditor account, which is in the nature of liability, it will be credited in case of an increase. And if the account involved is sales, which is a revenue account, it shall be credited to show an increase. Now, let's study journal. Transactions are first entered in this book to show which accounts should be debited and which credited. Journal is also called subsidiary book. Recording of transactions in journal is termed as journalizing the entries. It is the book of original entry in which the transactions are entered on a daily basis in a chronological order. Let's look at the journalizing process. All the transactions may be first recorded in the journal as and when they occur. The record is chronological, otherwise it would be difficult to maintain the records in an orderly manner. Debits and credits are listed along with the appropriate explanations. There are basically two types of journals. 1. General journal and 2. Specialized journal. The latter is used when there are many repetitive transactions of the same nature. The form of journal is as follows. the columns have been numbered only to make clear the following, but otherwise they are not numbered. The following points should be noted. In the first column, the date of transaction is entered. The year is written at the top, then the month, and in the narrow part of the column, the particular date is entered. In the second column, the names of the accounts involved are written. First, the account to be debited with the word DR written towards the end of the column. In the next line, after leaving a little space, the name of the account to be credited is written preceded by the word to. The modern practice, however, shows an inclination towards omitting the DR and to. Then, in the next line, the explanation for the entry together with necessary detail is given. This is called narration. In the third column, the number of the page in the ledger on which the account is written up is entered. In the fourth column, the amounts to be debited to the various accounts concerned are entered. In the fifth column, the amount to be credited to various accounts is entered. Now, let's have a look at points to be taken care while recording a transaction in journal. Journal entries can be a single entry that is one debit and one credit, or a compound entry that is one debit and two or more credits, or two or more debits and one credits, or two or more debits and credits. In such cases, it is important to check that the total of both debits and credits are equal. If journal entries are recorded in several pages, then both the amount column of each page should be totaled and the balance should be written at the end of that page, and also that the same total should be carried forward at the beginning of the next page. Now, let's have a look at advantages of journal. In journal, transactions are recorded on the basis of double entry system, fetching the following advantages. 1. As transactions are recorded on chronological order, one can get complete information about the transactions on time basis. 2. Entries recorded in the journal are supported by a note termed as narration, which is a precise explanation of the transactions for proper understanding of the entity. One can know the correctness of the entity through these narrations. And 3. Journal forms the basis for posting the entries in the ledger. This eases the accountant in their work and reduces the chances of error. Now, let's begin with ledgers. After recording the transactions in the journal, recorded entries are classified and grouped into by preparation of accounts. The book which contains all sets of accounts, viz. Personal, real, and nominal account, is known as ledger. It is known as the principal book of account, in which account-wise balance of each account is determined. Let's look at the specimen of ledger accounts. A ledger account has two sides: debit, which is the left part of the account, and credit, which is the right part of the account. Each of the debit and credit sides has 4 columns. 1. Date. 2. Particulars. 3. Journal folio, that is the page from where the entries are taken for posting, and 4th, amount. Here's a specimen of the ledger. Now let's learn about posting. The process of transferring the debit and credit items from journal to classified accounts in the ledger is known as posting. The rules regarding the posting of entries in the ledger are: separate account is opened in the ledger book for each account and entries from ledger posted to respective account accordingly. It is a practice to use the words to and by while posting transactions in the ledger. The word to is used in the particular column with the accounts written on the debit side, while by is used with the accounts written in the particular column of the credit side. These to and by do not have any meanings but are used to the account debited and credited. The concerned account debited in the journal should also be debited in the ledger, but reference should be given of the respective credit account. Now let's learn about balancing an account. At the end of each month or year or any particular day, it may be necessary to ascertain the balance in an account. To ascertain the balance in any account, what is done is to total the sides and ascertain the difference, that is, the difference is the balance. If the credit side is bigger than the debit side, it is a credit balance. In the other case, it is a debit balance. The credit balance is written on the debit side as to balance CD, CD means carried down. By doing this, two sides will be equal. The totals are written on the two sides opposite to one another. Then the credit balance is written on the credit side as by balance BD, that is brought down. This is the opening balance for the new period. The debit balance similarly is written on the credit side as by balance CD. The totals are then written on the two sides as shown above. Then the debit balance is written on the debit side as to balance BD as the opening balance for the new period. It should be noted that the nominal accounts are not balanced. The balance in the end are transferred to the profit and loss account. That is similar to the income and expenditure account for non-profitable organizations. Only personal and real accounts ultimately show balances. This brings us to trial balance. Trial balance contains various ledger balances on a particular date. It forms the basis for preparing final statement, that is income and expenditure statement and balance sheet. If it tallies, it means the accounts are arithmetically accurate, but certain errors may still remain undetected. Therefore, it is very important to carefully journalize and post the entries, following the rules of accounting. So let us begin with the introduction of trial balance. Preparation of trial balance is the third phase in the accounting process. After posting the accounts in the ledger, a statement is prepared to show separately the debit and credit balances. Such a statement is known as the trial balance. It may also be prepared by listing each and every account and entering in separate columns the totals of the debit and credit sides. Whichever way it is prepared, the totals of the two columns should agree. An agreement indicates reasonable accuracy of the accounting work. If the two sides do not agree, then there is simply an arithmetic error or errors. Let's look at the objectives of preparing the trial balance. The preparation of trial balance has the following objectives. Trial balance enables one to establish whether the posting and other accounting processes have been carried out without committing arithmetical errors. In other words, the trial balance helps to establish arithmetical accuracy of the books. Financial statements are normally prepared on the basis of agreed trial balance, otherwise the work may be cumbersome. Preparation of financial statements, therefore, is the second objective. The trial balance serves as a summary of what is contained in the ledger. The ledger may have to be seen only when the details are required in respect of an account. The form of trial balance is simple as shown below. The under-mentioned points may be noted. A trial balance is prepared as on a particular date, which should be mentioned at the top. In the second column, the name of the account is written. In the fourth column, the total of debit side of the account concerned or the debit balance, if any, is entered. In the next column, the total of the credit side or the credit balance is written. The two columns are totaled at the end. The first and the third column needs no explanation. Now, let's look at the limitations of trial balance. One should note that the agreement of trial balance is not a conclusive proof of accuracy. In other words, in spite of the agreement of the trial balance, some errors may remain. These may be of the following types. 1. Transaction has not been entered at all in the journal. 2. A wrong amount has been written in both the columns of the journal. 3. A wrong account has been mentioned in the journal. 4. An entry has not at all been posted in the ledger. And 5. Entry is posted twice in the ledger. Still, the preparation of the trial balance is very useful. Without it, the preparation of financial statements, the income and expenditure account, and balance sheet would be difficult. Now, let's have a look at the methods of preparation of trial balance. First is total method. Under this method, every ledger account is totaled and that total amount, both of debit side and credit side, is transferred to the trial balance. In this method, trial balance can be prepared as soon as the ledger account is totaled. Time taken to balance the ledger account is saved under this method, as the balance can be found out in the trial balance itself. The difference of totals of each ledger account is the balance of that particular account. This method is not commonly used as it cannot help in the preparation of financial statements. Then we have the balance method. This method is used commonly by the accountants and helps in the preparation of the financial statements. Financial statements are prepared on the basis of the balances of the ledger accounts. And then we have total and balance method. Under this method, the above two explained methods are combined. Under this method, the statement of trial balance contains 7 columns instead of 5 columns. An illustration of this method can be seen on the screen. Now, let's learn about adjusted trial balance through suspense account. If the trial balance does not agree after transferring the balance of all ledger accounts, including cash and bank balance, and also errors are not located timely, then the trial balance is tallied by transferring the difference of debit and credit side to an account known as suspense account. This is a temporary account open to proceed further and to prepare the financial statements timely. Let us now learn the rules of preparing the trial balance. While preparing the trial balance from the given list of ledger balances, following rules should be taken care of. 1. The balances of all asset accounts, expense accounts, losses, drawings, cash and bank balances are placed in the debit column of the trial balance. And 2. The balances of all liability accounts, income accounts, profits, and capital are placed in the credit column of the trial balance. This brings us to the end of this video. Thank you.